Hello, everyone, and welcome to Zonda's Back to School edition of the Mortgage Playbook webinar. My name is Nicollette Chapman, and I am so pleased to be joined today by Allie Wolf, our incredibly talented chief economist, as well as an all-star group of panelists. Now, before we begin, do note that we talk fast and are going to cover a lot of ground. So if you miss anything, don't worry, we will follow up with a link to the recording later today. Please submit your questions at any time, and time permitting, we will answer them live. At the end of the event, please do remember to take a moment to fill out our exit survey. Now, who are we? We are Zonda, a housing and consultancy firm. We track the entire building life cycle from raw land all the way to the closeout of new home communities. Our database tracks actively selling communities across the country, and we can tell you who the best-selling builders are and where to find the best-selling communities. Today's event is sponsored by Zonda Mortgage Pro. If you aren't familiar with Zonda Mortgage Pro, I can tell you it is essential if you are trying to get builder business. This product will help lenders secure more builder business by helping them identify opportunities to connect with builders who do not have a solid lender relationship and track market share down to that subdivision level. Simply stated, in addition to helping identify potential builder business, Mortgage Pro can also help you connect with those decision makers and grow your share of the new build market. We're thrilled to announce some new enhancements, which include future supply data, the Builders and Subdivisions tab, and our new Builder Profile tab. At the end of the event today, if you're interested in learning more about how Mortgage Pro can help you grow your builder business, please make sure to let us know through that exit survey. We also are thrilled to announce our market snapshots. Zonda now offers complimentary housing market snapshots for the top 65 U.S. core-based statistical areas. You can stay up to date on the latest housing market data specific to your real estate market of interest. While the robust data points you to where you need in multiple reports, Zonda has it ready for you in all one place. Please request your free snapshot today. We're also thrilled to talk about Livable, which is our new reimagined new home listing platform. It offers the most accurate and comprehensive new home listings. It's made with builders in mind and is free to list communities and exclusive to new construction homes only. It also is available in urban and suburban communities in the United States and throughout Canada. And then lastly, we are excited to announce the latest addition to Zonda's portfolio, U-Tours. U-Tours represents the industry's most robust on-demand self-tour solution, making it easy for home shoppers to enjoy interactive, self-guided tours of new homes on their schedule, even early mornings or late evenings. Acquired earlier this past week, U-Tours will fully integrate with Livable, which is Zonda's new home construction listing sites, and further enhance our commitment to becoming a leading residential real estate technology provider focused on the new home market. Now, moving on to our events, we are excited to be able to announce our MFE conference, which is for the multifamily market, coming up in Dallas in September. And then we also have a brand new event called Elevate, which is all centered around high-rise living, and that will be in Miami Beach in December. For more information or to use one of our discount codes, please see the slides below. Now, on today's agenda, really excited to be able to kick the 30-minute session off with an incredibly packed housing update. Allie is going to cover a lot in just a 10 to 11-minute time frame. There's certainly no shortage of items to discuss. We'll then speak to some of the industry's best and brightest in order to help you navigate this market. And so please allow me to introduce you to our own housing guru, Chief Economist Allie Wolf. For those of you who have not had a chance to hear Allie speak before, you are in for a real treat. Allie has been featured on various platforms, including Bloomberg TV and Yahoo Finance, and currently consults the White House on housing affordability. She's a well-respected thought leader and has a bachelor's degree in economics from The Ohio State University and a master's degree from the London School of Economics. Now, if you've been into our webinars before, you know that Allie and I like to share a little fun fact about one another. And so even though Allie travels all over the country for work, she just couldn't stand to keep her feet on the ground over the summer. And so she recently spent some time in Egypt. And when I was asking her if anything interesting happened on her trip, she told me that she learned she was claustrophobic inside of the pyramids. I told her, I already know I'm claustrophobic, and thus you will never see me anywhere near a pyramid. But that being said, she is quite a daredevil. She also rode a quad through the desert while there. So with that, Ali, I'm going to leave the daredevil and claustrophobic activities to you and let you speak on some housing economics.
Awesome. Thank you so much, Nicollette. And I didn't know, but I guess you realize that there's no windows and there's only one way in, one way out. It just kind of gives you the heebie-jeebies. But thank you everyone for joining us today. Like Nicollette said, very short period of time, but we're trying to get as much information in as possible. So where I wanted to start is really with this shift that we've seen in the housing market and the mortgage market over the past month. Now, it's well understood at this point why we've seen interest rates go up over the past year. The combination of 11 short-term rate increases from the Federal Reserve, the inflation levels that continue to be higher than our policymakers would like to see, and the market dysfunction that we've seen in the mortgage-backed securities market and how that's leading to a wider spread than normal between the 10-year Treasury yield and the 30-year fixed-rate mortgage. The big thing that has changed, though, just over the past 3 to 4 weeks is what's happening in the bond market related to supply and demand. So we had the Treasury come out and really surprise the market by issuing more bonds than originally anticipated because we have to continue to fund our budget deficit. Now, normally when you have an increase in supply, you hope that there's this good balance with what's happening with demand. But we know that the Federal Reserve has pulled back as a buyer. We know investors are shifting where they're placing their money. And we also know that our foreign investors, namely from Japan and China, have their own idiosyncratic things going on in their local markets, which is playing into their appetite for bonds. So supply and demand from the bond market, plus this realization that, hey, most economists thought that we would fall into a recession by the end of this year. And at least as the data is trending right now, it doesn't appear to be the case. And so investors are now expecting higher for longer rates, which has changed where they're allocating their funds. So all of this has contributed to rates now pretty steadily hanging above that 7% mark. Now, as we think forward, there are some reasons to believe that interest rates will go back down to the 6s or maybe 5s. And the two key things that we're watching is what ultimately happens with a Federal Reserve rate cut. We don't think a rate cut's coming this year. Maybe it happens around the middle of next year. But traditionally, we know that mortgage rates come down before the Fed starts cutting rates. We also know that market dysfunction that I talked about between the 10-year and the 30-year usually lasts between 12 and 24 months. We think maybe we won't have a full reversion to the mean, but we do think that that spread ultimately will compress. So a couple things to look forward to of where interest rates might go, but it doesn't change the reality of what's happening right now. Interest rates in the 7s, first time we've seen this since last year, and it's really contributing to this record affordability shock that we've seen. A 73% change in the typical monthly mortgage payment just since the beginning of last year, and a 60 to 80% change depending on the market that you're talking about. So we're finding that higher rates and the fact that home prices are even going up a little bit this year really should be weighing on sales, and they are. When you look at existing home sales, this is the largest part of the market, and we find that they're down year over year. They're down compared to last month. They're down compared to 2019. You find this on a national basis, but you also find this on the local basis. So we can look at the sales numbers, and we understand that sales are partly down because of rates and affordability. Sales are partly down because consumers just feel a little bit uncomfortable with where home prices are today or with where mortgage rates are today. But I would say existing home sales are largely down because of what we're seeing with inventory. So as we look at active listings, again, both nationally and locally, we're finding that in most markets, listings remain extremely constrained, not only on that year-over-year basis, but also compared to where we were in 2019. Now, for context, in 2019, as we were meeting with our clients, we were already saying at that point that inventory felt so tight, and it's only gotten tighter since. It makes sense. There's a disincentive to sell. 80% of people that have a mortgage have one under 5%. 60% of people that have a mortgage have it under 4%. So we know some people are saying, you know what, I'm going to stay put. Maybe I'm going to remodel my house. Maybe I'm going to turn my house into a rental, but I'm not that eager to sell this home. But it doesn't mean there aren't still people that are out shopping. And this is where we see this big divergence emerge in the market. As you look at existing home sales, we find that they are at the lowest level in 6 months. As you look at new home sales, this is tracked by Zonda, we're flat month over month, we're up year over year, and we're notably above that healthy year for comparison, which is 2019. So we really have a tale of two different housing markets that have emerged. The existing home market that's really in this stalemate, and the new home market that's there to pick up some of the slack. Now, as you look at this trend for new home sales, this really stands out as something that you wouldn't think would happen, because the Federal Reserve has been raising rates, and they are blatantly clear that when they raise rates, they know that they'll impact the interest rate sensitive sectors of the economy the most. And so you would expect that demand would drop. And we saw this last year, third and fourth quarter. But there's been an unintended consequence of what's happened with the higher rates, which is supply has come down even more. And the resulting impact here is those that have inventory have been able to benefit in this market, whether that's an existing home seller or whether that's the new home community. In fact, as we look at new home inventory, builders traditionally have represented between 10 to 15%, where they are today, 33%. So we know that the new home market is outperforming, but we also wanted to get a sense in real time from builders how consumers are responding to interest rates going back in the 7%. So we can track this with our hard data, but we also like to supplement it with conversations with a division president survey. And so in August, as interest rates were going up, we said to builders, hey, how does the market feel relative to what you thought would happen? Well, as you look at this, the highest share, 40% of the respondents said demand is still on track with what we expected, despite interest rates back in 7%. Our second highest answer, if you combined the two responses of demand is slower, we have to break that out. We have some builders saying that demand is slower, but it's not worrisome. In fact, that's 25% of the respondents. And the way that I view this is they're saying it's seasonal. August should not be and is not traditionally as strong as March or April or May, for example. Then we have 12% of builders, which I actually think is surprisingly low, that are saying, hey, demand is slower than expected and it's causing concern. And as I went into the comments, I think there's no surprises here. Funds to close and monthly mortgage payments are much higher than buyers can handle. The market is slowing down. Or I think really indicative of today's market, there's strong interest, but financing remains the main issue. And this is what builders are trying to juggle. So let's go back. End of last year, the market had slowed. Builders did what we called ripping the Band-Aid off. They lowered prices to figure out where consumers would re-enter the market. It proved to be a really effective strategy. Consumers returned to the market, started buying homes again. So much so that throughout this year, builders were actually raising prices again. Over 50% of builders raised prices in May and June, 44% in July, went down to 37% in August. What builders are trying to figure out is what's the right balancing act of understanding that right now they have this pricing power, but of course, affordability is our biggest issue. And builders are trying to be very cognizant of that, but also are very aware that there's this unique period of time that is such a big opportunity for the new home space. Builders right now have the ability to compete with three main buyers. Buyer one, someone who would traditionally buy a resale home. They like maybe that they can see the home that's already built, but probably they like the fact that they can lock in the price and they can lock in the rate. Well, builders have been increasing their construction of homes that are known as quick move-ins, QMIs. These are homes that can be moved into within 90 days and are direct competition of that resale inventory, for which we know resale inventory is so tight. Builders can also work with the discerning buyer, someone that's saying, okay, well, if I'm going to buy today with a high interest rate and a high price, I want to make sure that I'm getting a good product on the other side. And that's where the to-be-built homes come in. And I'd say most importantly, builders are in a place to work with the affordability challenged buyer, more so than what you would see on the resale market. In fact, as we look at the projects across the country that are offering quick move-in incentives, in some top markets, that's ranging from 80 to 90% of every single new home community that is offering some kind of incentive to help seal the deal with the consumer. And when we ask the builders about this, we say, hey, what's the most effective way to get consumers off the sidelines? Probably no surprise. Number one answer, mortgage rate buy downs, whether variable or fixed. In fact, I saw a big public builder right now is paying 11 to 12 points on the front end and the back end to get rates to 4.75%. We also see second highest response, funds towards closing costs. So while builders have been able to gain share, I think one of the biggest things that we're tracking in the market is really what we're calling this pent-up demand. That yes, there are still some people that are buying today, but we also know there are a lot of buyers that are sitting on the sidelines. And as they're thinking about what's next, we know from Federal Reserve data that 25% in 2022 and 26% of homeowners under 50 years old want to move again within the next 2 years. Right now, there's a lot of people that are holding place, but I think as we see interest rates come down, as we see the market stabilize more, we think the market can continue to grow once we get past some of this uncertainty. Now, with that, I'd like to reintroduce Nicollette Chapman, our Senior Vice President of National Mortgage Sales. Now, Nicollette had quite the August. She found out 3 days before she left for vacation that she got a promotion, and then spent the next couple of weeks visiting 3 countries, 5 cities, took 8 plane trips, very similar to me. I think we need to stay home, but we can't help ourselves. We keep going. So Nicollette, well-deserved. Congratulations on the promotion and welcome back. I'll turn it back to you.
Thank you so much, Ellie. Great information. And also thanks for the kind words. Yeah, I think we just can't stop, won't stop. Don't know how to put our feet on the ground, do we? So it's just who we are. Well, I'm really looking forward to asking some questions after what you just presented to our esteemed group of panelists today. I do want to take a moment to introduce who they are. Today, we have Tim Peterson with Academy Mortgage. We have Dan Peña with LoanDepot, and we have Christine Madrid with Movement Mortgage. Just a brief background about each of our panelists today. Tim Peterson has been in the housing finance industry since 1997 and with Academy Mortgage specifically for over 10 years. He currently works as the National Builder Manager and is focused on builder development, acquisition, and strategy. Prior to this role, he was a regional manager of Utah and Colorado and oversaw over $2 billion in production in just those 2 states as Executive Vice President of Operations, overseeing the company's field-facing operations nationally. Moving on to Dan Peña. Dan is an industry veteran with over 30 years of experience and began his career as a top producing originator and held a number of leadership roles in sales prior to moving over to the operations arena. In 2015, he was promoted to the EVP of Joint Ventures nationally, taking charge of LoanDepot's joint venture and national builder account relationships. Since then, he has nurtured multiple exceptional partnerships, including Meritage Homes, LGI Homes, Michael Saunders and Company, TriPoint Group, and Brookfield Residential. And then lastly, but not least, of course, Christine Madrid is also an industry veteran and has been in the business since 2005. She is a new construction expert and ran the builder condo division for Caliber Home Loans for 7 years prior to being promoted to the director of the national condo division in 2021. She now leads the West Division for Movement Builder and Condo, where she manages 9 different states. Christine has been the preferred lender for approximately 32 different condo and single family construction projects over the past 18 years. So you can see we have a great group today to answer some pretty difficult and timely questions. So let's go ahead and get started. I know that Allie just gave us some really interesting economic data, and I think it's important to be able to just start off by ripping off the Band-Aid and addressing the elephant in the room. Let's start with Tim. Tim, do you think that mortgage rates will hit 8% before they start coming down, and why or why not?
I tend not to think they're going to quite get that high. It seems like, as the pendulum swing on the interest rate front, at the end of the pendulum, it starts to kind of slow down a little bit. And we're seeing that with some taming of inflation, CPI data, shelter costs, et cetera. And I think you couple that with economic challenges, with increases in debt on a household basis. And then, of course, all things commercial real estate and the challenges coming there. It seems like we're kind of slowing down on that front. So I can see a few shifts over the market, but I'm very hopeful that we won't hit that point.
I'm hopeful as well. So you don't think quite 8, but how close to 8 do you think we might get? 7?
Okay. I could see it going up to that 7.6, 7.7 mark on the high end.
Right. Buckle up, I guess. How about you, Dan? Do you tend to agree?
Yeah, I agree with everything you said. And I'm also smart enough to know that you don't go after Allie and try to answer a question like that. But, I follow Allie religiously, and we follow, everything else, MBA and Fannie Mae, and everyone has it coming right around, high 6s, low 7s at the end of the year. And I tend to agree with that for all the reasons Tim and Allie mentioned. So I would agree that it's not going to hit 8%. And I believe we're probably going to end up at the low 7s, rather, about 7.25.
Perfect. And so on that point, actually, I want to move on to the next question because you just sort of touched on it a little bit. So on that topic of rates, where do you think we'll be ending 2023 and again, halfway through 2024? Dan, you mentioned, 6s, mid 6s, end of 2023. Where do you think we're going to be Q2 2024?
Oh my gosh, I'm going to look ridiculous because you're going to pull out old interviews and it's going to say the same thing I said last year and the year before. But I honestly believe that the market will right size. All of the craziness in the secondary market, capital markets will level out. I am hopeful that we will end up in the high 5s, low 6s. And honestly, whether it's higher or lower than that, just stability, I think, is really, really important for us. We didn't talk a lot about stability, but just the market being stable and staying at 5 or staying at 6 for any given period puts a lot of relief to the customers and their confidence in purchasing a home.
I think it's a great point. Christine, what do you think? Where do you think we're going to be end of the year and midway of 2024?
Well, I agree with Dan. I mean, first of all, I do think rates are going to moderate for a little while, and we'll continue to see some volatility until we have really achieved an economic landing. And as Dan indicated, that will bring some confidence into the market. As far as next year goes, I'd love to believe the MBA's forecast because they're forecasting closer to 5 by the end of next year. But realistically looking at it, I think that midway through the year, I will be super happy if we start heading down towards 6. And so I am hopeful that we hit 6 by the end of the year. I think by mid-year, we still could be in the mid 6% range, though.
Yeah. So we're just hanging there a little bit longer, right?
Yes, exactly.
Perfect. Tim, do you tend to agree or anything that you'd like to add?
I just think it's going to be extremely tempered. Meaning I think those MBA predictions are a little aggressive. I think it's going to be, slower moving. So, at least that's how I treat the business. We treat the business and are planning that way, that we're going to see a much, tempered decline. Hopefully, mid 6s by that point in time, into mid next year.
Sure. And I want to say, because I agree, I think you guys are all on the right track. But Allie and I always say that if you are going to predict rates, you have to do so with a lot of humility. So no one on this call is allowed to rewind and tell us we are wrong. So we are all very humble here when we talk about the future of interest rates. So let's move on to the next question, because one of my favorite parts about having a panel is really hearing straight from the mouths of people who are in the trenches at ground zero, taking applications, managing pipelines. So based on what you are seeing in your own business, how many buyers do you think are going to re-enter the market, whether that's because they're able or willing, in order to purchase once rates get back into the fives? And what effect do you think that will have on the overall market? And Christine, I want to start with you because I think you have some interesting perspectives on this piece of it.
Well, it's really, I would love to say it's my perspective, but US News did a survey in April, and I found this very fascinating because they reported that 66%, so 2/3 of prospective buyers who are planning to use a mortgage to purchase a home, said that they were going to wait for rates to drop. And that broke down to 30% will wait until rates drop below 5.5%. 28% want to see rates just below 6%, and 26% below 5%. And so 61% of those buyers are first-time home buyers. 77% regret not buying a home previously, obviously. But the other really interesting thing I found in that article is that they said that 25% of current homeowners who intend to buy a home will keep their current home, thus further impacting our inventory challenges.
That's interesting. And I think a piece of that, right, that we all sort of talk about, the people that say it's not a great time to buy when rates, are in the sevens, is if you really look at it, when rates go back down in the fives, it's going to cause a feeding frenzy of the limited inventory that actually exists, which in turn drives up prices, right? So if you look at it from that standpoint, I think now is the time to buy. If you are able to qualify in the sevens, you're going to get a much better deal in negotiating before that feeding frenzy starts. But wow, 77% did you say wish they would have purchased?
66%. Yeah.
Well, there you have it. Don't FOMO there, right? For sure. Dan or Tim, anything that you want to add on that piece of it? I'd love to hear what you guys are seeing just in terms of having feet on the ground.
Yeah, I'll go ahead and go, Tim. Thank you. So I was going to say, first off, it's always a good time to buy a home. So I'll lead with that. But that's a whole different discussion. But, I think everything Christine said is accurate. We are still seeing a lot of pre-quals. I mean, the velocity of pre-quals hasn't slowed down, but the amount of conversion and pull-throughs has slowed down. Not to the point where people are nervous, where our home builders are nervous, but they have slowed down. But the part that I think it's worth talking about, and I think there's another question coming up on it, so I don't want to get ahead of ourselves, but our builders, like you mentioned earlier, and like Allie mentioned earlier, are creating ways to bring that interest rate down. So yes, there is a demand, but we're pulling from that demand as we speak right now. So it would be interesting at some point if the builders stop, lowering those rates on behalf of the consumers, to see what would happen. I think this would be a more valid question, like, now what happens, right? Because now people are really sitting on the sidelines, because now they're really not getting like the 4.9 that somebody mentioned, or 5.5 that the builder's providing. Now they are at 7. And so that would be interesting to have a discussion around as well.
For sure. And I think it's even interesting, I read LinkedIn posts all the time. And one of the topics obviously is those buy downs. And there's still so much miseducation out there about, it costs the buyer more money up front, or it's hurting the buyer, and they don't really understand that it is truly a builder incentive. So I think that's part of what our jobs are, is to go out there and educate the public on, the reality of what a rate buy down is and how significant it is to be able to get that in this marketplace, for sure. Before we move on to our next questions, I just want to address for everybody, and I know that we said it was going to be a 30-minute webinar. We are scheduled to go just a little bit over. So if you have to drop, just know that recording is going to be sent out later today. And we do apologize, we're going a little bit over, but I think some of these panelists have some great things to say. So if you can stay on, please do so. If not, just know that it will be sent out to you. Tim, I do want to get your input on that question as well.
No, perfect. We know the supply of buyers, that river that was flowing with buyers, I mean, it got dammed up by the feds, and obviously that created a big pool. I kind of like to be illustrative sometimes in the way I talk, like a mini ice age came through as well and froze a bunch of those buyers. And of course, those are those buyers that already own homes in the 2, 3, and 4 interest rates. Well, but the rivers never stop flowing. And what we're seeing right now is it's starting to spill over that fundamental demand in the market. And that's where we are right now. And so, as Dan mentioned, we are seeing momentum. We are seeing more and more applications, and of course, all things controlled by the builders. That frozen group, though, that's going to take years to melt. I think it's going to be really incremental and really, somewhat slow moving. But as all things, be ready when the heat wave comes, because we're going to have some great opportunities to capture business. When they come down a little bit, lower that dam, you're going to see these little mini floods that come in, and there'll be a great opportunity to capture those buyers.
For sure, definitely. So moving on to that next question, and because again, love to know what you guys are hearing on the street, what's happening in your day-to-day life. This question, I think I want to start with you, Christine, because one of the things that's interesting about your background is that you also are a partner in a home building company. And so I want to know what is important to you as a home builder, but also on the mortgage side, what products are builders asking for right now? Are they asking for forward commitments? Are they asking for those permanent rate buy downs, which I assume that's an obvious yes, based on what Ali and all of us have talked about earlier. But what about things like model home lease backs now that there's credit tightening that's happening? What ways are you able to be creative yet compliant in today's marketplace in order to ensure a healthy pipeline?
Well, I think, first of all, one of the things that everyone appreciates is with the banks constricting with credit and their balance sheet, small to mid-sized builders are now faced for the first time, and this has happened with my own home building company. We have always been a bankable builder. And for the first time in 7 years, despite our strong cash position, our success as operators, because the regional banks who are traditionally lending in the construction world to us are pulling back, we are faced with private financing, which obviously means higher rates. And therefore, it's increasingly critical right now to ensure that lenders are closing on time because of the cost of extension and higher interest rates. And so as far as the products that builders are asking for, sure, as a builder's lender, you have to have all of the basics, non-QM products, longer term locks, temporary buy downs, even for jumbo. But you really also have to be an expert on structuring, because as Ali mentioned, there's now an opportunity for some of these buyers who have been priced out of the market before just because of competition, that the builders are really incentivized to really make every sale count. And so when you are looking at a lower down payment buyer, for example, take a 5% down buyer, you have things like a 3%, you're limited with conventional loans with a 3% interested party contribution. So taking a look at, how do you help those buyers get across the finish line? Because they may need something in addition to assistance with closing costs. So it could be that you do a forward commitment because those don't require, they don't go against our interested party contributions. So it's really structuring and being creative and taking each buyer's situation and figuring out how to help the builder structure the deal to get them to close.
That's a great point. Thanks, Christine. Tim, what do you have for us?
Yeah, I mean, when you ask what are the builders asking for, consistently, they're really asking for 3 things always. Capital, help selling more homes, and ways to save money, be more efficient, and drive more margin. And so everything that we do is really focused through that filter. What we're doing on the forward commitment front, for example, there's an absolute perfect place for those, because what those do and the commitments we're executing on with our builder partners, that's allowing us to create, as optimized as possible, an economic condition that balances the payment for the buyer and the economics and profit margin for the builder. But you've got to be in deep with these people. These conversations that we're having with, owners, CFOs, head salespeople, it's really a go slow to go fast approach to, again, be able to market the right products to the clients. And then, of course, having the team behind, both groups that can execute on it.
Great points. Dan, what about you?
Yeah, I agree with everything that was just said. I mean, our primary objective is to help our partners sell homes, period, whether it's a real estate company, a bank, or of course a builder. We want to help them sell more homes, and by doing all the things that you've got listed here and more, we try to go to them with creative products if we can, as opposed to them asking us. Bond is another product that's kind of been out there and getting some traction behind it. Not a huge fan of Bond, but in times where you've got to help them sell homes, you've got to do what you've got to do. So we've kind of gone heavy into that space. And I think forward commitments has probably been the strongest tool for them. I mean, we've done, since we got heavy into it in the last 2 years, we've done just over 3 billion of it in the last, call it 20 months. So we've gone deep into that space. But Tim said something very interesting is you have to do some comparison, right? You have to look at your pipeline, that builder's profile, and figure out what rate's going to give you the best bang for your buck and still be margin conscious and P&L conscious for your partners. So it is trickier than it seems. You can't just say, here, buy this at 4.99 for 10 points or whatever it is. There's a lot of work that goes into it and a lot of back and forth between your partners to make sure you're getting the best deal for not only the consumer, but for your P&L.
Sure, definitely. Okay, and lastly, because we are over, so give me in just a one quick sentence, what piece of advice would you give to a loan officer looking to expand in the builder space in this market? One sentence, Christine, go.
You have to be willing to invest the time and effort. You can't shoot it, kill it, and need it right away. But if you do that, if you do invest the time and effort, it will pay off big.
Perfect. Dan.
Understand your builder partner's product, communities, and know it like it's your own.
Perfect. And then provide solutions that match up with that.
That's right.
Right? Absolutely.
That's right.
And then Tim.
Yeah, I mean, if you want to be in the builder business, you have to be with an organization that has the people, the tools, and the sophistication to support the builder. You cannot do it on your own. So small shops, broker shops, they'll never be able to keep up with the organizations that have that dialed in. And then I concur with the other group, what they said as well. You got to go deep and be willing to play the long game with these builders. So start playing it now. The longer you wait, the longer it's going to take you to build your business.
Absolutely. And we know that builders are the future of supply. There's not a lot of resale inventory coming on the market. So if you want to be in the business, there's just no other choice than to commit to understanding and learning builder. Certainly a future of where the inventory is. And so with that, I do want to thank you. I apologize again. We did go 8 minutes over, but I think we covered some really good ground today. I do want to thank you all for attending. The recording will be posted within 24 hours on our social media channels, as well as on our blog at www.zondahome.com/blog. You will also get an email with a link to the recording, but please do make sure to follow us on LinkedIn, X, which was formerly Twitter, Instagram, Facebook, YouTube. We've got it all. Thanks again for joining us. And please do take a minute to fill out that exit survey. Have a great day, everyone, and go get that builder business.
Thank you.
Thanks.